The billionaires are about to get a lot richer because most people don't know how to invest during a recession, they only know how to react to one. So before we talk about exactly how you can take advantage of this, let's first talk about what happens during a recession. First, people stop spending money when people tighten their belts, so do businesses. You might have seen some of your favorite restaurants or stores close down. Next, stock prices drop. When a recession hits, it feels like all the bad news spreads like wildfire. Everyone is talking about how bad things are going to get, which makes everyone else think that things are going to get worse. So they sell their stocks and the prices drop even further. It's a vicious cycle. Now, this is where it gets interesting. While everyone else is selling, the billionaires are buying. Warren Buffett famously said, "Be fearful when others are greedy, and be greedy when others are fearful." During recessions, billionaires scoop up incredible deals. And here's how you can do the same, even if you're broke. The first way is to invest in defensive sectors. During a recession, some sectors perform better than others. Look at the healthcare sector, for example. No matter how bad the economy is doing, people still need medicine and medical procedures. So the healthcare sector tends to be pretty stable. Or check out the consumer staples sector. No matter how bad the economy is doing, people still need to eat, so grocery stores and food companies tend to do well. Now you might be thinking, "Great, Alex, but I don't have enough money to invest in those sectors." Let me show you how. Most ETFs have a ticker symbol. Ticker symbols are like stock symbols for ETFs, and guess what? There are entire ETFs dedicated to the healthcare, consumer staples, and utilities industries. So you can invest in an ETF like XLV, which tracks the healthcare sector, or XLP, which tracks consumer staples, or even VPU, which is an ETF that invests in utilities. Not only will these ETFs give you instant diversification, but you can also buy them with just a few dollars. But there is a catch. Unlike stocks, ETFs usually have minimum investment requirements. But here's a trick to get around that. Most brokerages allow you to buy fractional shares of ETFs. So if an ETF costs $100 per share and you only have $50 to invest, you can simply buy 1/4 of a share. Which brings me to my next point. Don't try to time the market. If you want to make the most out of your investments, then you need to dollar cost average. Dollar cost averaging is simply the practice of investing a set amount of money at regular intervals, regardless of the price of the stock. Imagine you have $100 and you want to buy $100 worth of stock. One way would be to buy one share of a $100 stock. But what if the stock is $50? You'd be able to buy 2 shares. With dollar cost averaging, you're able to buy more shares when prices are lower and fewer shares when prices are higher. Plus, studies have shown that dollar cost averaging is a more effective strategy than trying to time the market. In fact, according to a study by J.P. Morgan, since 1980, the S&P 500 has had an average of 10 trading days of 1% or more gains, and an average of 18 trading days of 1% or more losses. This means that if you were only able to capture the best 10 days of the market over the past 4 decades, your annual return would have been 17.7% compared to just 2.9% if you had traded actively. Which brings me to my next point. If you're broke, buy fractional shares of ETFs. Remember, you don't need to buy whole shares of stocks. If you have $10, then buy 1/10 of a share. If you have $20, then buy 1/5 of a share. If you have $100, then buy one whole share. For example, if you wanted to invest in an S&P 500 ETF like VOO, you could buy 1/10 of a share for $10, 1/5 of a share for $20, or 1 share for $100. You could do the same thing with VTI, which is an ETF that covers the entire US market, or even SCHD, which focuses on dividend-paying stocks. SCHD has been a great one for me personally because it gives me a nice passive income stream, and remember, consistency is key. When you're investing during a recession, it's important to stay consistent with your investing. Keep investing even when the markets are down. Keep investing even when the markets are sideways. Just keep investing. And finally, don't wait for the perfect time to start investing. Warren Buffett famously said, "The best time to plant a tree was 20 years ago. The second best time is today." So if you've been waiting for the perfect time to start investing, that time is now. And with that said, you have an awesome day. Hit that like button if you're ready to invest through the storm, and hit that subscribe button if you want to grow your wealth with us. See you tomorrow.